For the last few days, something dangerous was happening very quietly. The Indian rupee was falling almost every single session. There were no loud breaking news alerts, no panic on television, no emergency announcement. And then suddenly, the fall stopped. Not because the problem disappeared, but because the RBI stepped in behind the scenes. Today, I will show you how close India actually was to a currency crisis. What did RBI did to stop it, and what this really means for your money. So, a currency crisis is not a forex trader's problem. It hits everyone. When a currency falls sharply, petrol becomes expensive, inflation rises, foreign investors pull the money out, stock markets become unstable, and even your mutual fund returns get affected. The scary part is currency crises don't start with a chaos. They start with silence because once panic begins, it's already too late to stop it. So, what pushed the rupee towards the edge? So, why was the rupee falling in the first place? Not because of one big shock, but because of multiple pressures stacking together. First, the US dollar became very strong globally. Now, when the dollar strengthens, almost every currency weakens against it. Second, US bond yields moved higher. So that made global investors shift money back to US for safer returns. Third, foreign investors started pulling money out of emerging markets, including India. Now, when FIs sell Indian assets, they convert rupees into dollars, putting pressure on the rupee. Fourth, the oil prices moved up. India imports most of its crude oil. So, higher oil prices means increase in dollar demand. None of these factors alone caused the crisis, but together they created the pressure. And pressure breaks currencies, not headlines. So, what did RBI actually did? Now, this is where most people get confused. The RBI did not call a press conference. It did not announce any emergency measure. Instead, it acted silently. First, the RBI started selling dollars in the spot forex market. This increased the dollar supply and slowed down the rupee's fall. Second, it used forward contracts, which means RBI promised to sell dollars in the future. This calmed traders without draining reserves immediately. Third, RBI managed the liquidity carefully. It ensured there was no panic shortage of dollars in the system. The key idea here is this: the RBI was not trying to reverse the fall, it was trying to control the speed of the fall. So, central banks don't fight markets aggressively, they smooth the volatility because panic spreads faster than inflation. Now, here is the most important truth that most people don't understand. The RBI does not want a very strong rupee. Yes, you heard that right. A slightly weakening rupee helps export, supports economic growth, and keeps Indian products competitive globally. What the RBI wants to avoid is a disorder fall. Forex reserves are not unlimited. Even trillion-dollar economics cannot defend a currency forever. So RBI's job is not to look heroic, it's to look boring. And boring central banks are usually doing their job well. Now, what does this mean for your money? So, what does this all means for you as an investor? Export oriented companies like IT and pharma generally benefit from a weaker rupee. Import heavy sectors like airline and oil marketing companies face the pressure. Gold often moves up when currencies weaken because it is seen as a store of value. Foreign investors watch currency stability very closely. When the rupee stabilizes, confidence returns. For long term investors, this episode is actually a positive sign. It shows that India still has strong forex reserves, credible institutions, and disciplined monetary management. Markets don't need miracles, they need confidence. So, what happens next? Is the danger completely over? In short term, rupees should remain relatively stable. In the medium term, everything depends on global factors: US interest rate, oil prices, and global risk sentiment. In the long term, India's fundamentals remain strong. This was not a victory lap for the RBI. It was the damage control, done correctly, quietly, and on time. If you want calm, rational explanations of what's actually happening in the market without panic or hype, subscribe to the channel. And if you want to understand why oil prices can shake the economy even more than RBI decisions, watch this next. Thank you.